Okay, folks, welcome to a brand new trading week. Welcome to Sunday Night Stock Charts Live. It is 1 week ago today where we saw the markets opened up on Sunday evening and we were dropping like a rock. And I made the statement mostly throughout that entire live stream that we need to think about buying, even though we probably could have had a Black Monday type event. And sure enough, that would have been, or that was the right outcome because we did some buying last week. And now we want to begin to become a little bit more wary. And I say this as the market is gapping up by over 1.5 percentage points. We're now pulling back. We may do a filling of the gap here. Now, this gap up is probably as a result of the news that came out on late Friday that there would be an exemption on tariffs for technology that would help out Apple. But Howard Lutnick, the trade secretary, came out today and said those exceptions would be temporary and not permanent. More tariffs are coming down the pike for semiconductor equipment, semiconductors. They want that stuff onshored along with pharma. So as I say this and look at the market gapping up, beware. The graveyards of traders are filled with people that bought and held on to stocks during bear market rallies. So I think that we still can move up higher, but we want to be wary of the macro picture of what's going on. And the question we need to ask ourselves is this: when we get a market rally, we want to ask ourselves a couple of questions. One, is there value in the market at these prices? The answer right now, we'll go to that in a minute to answer it. Question number two is, what's changed? Is there visibility? That's a part A and B question. Is there more visibility on the part of companies? The answer is no. So there's no reason right now to get uber bullish on this market for the long term. For a trade, sure, why not? So we're opening up here, MNQ up at current 1.4%. We're off the session highs. Let's check in with the E-minis. Actually, the ES, the big contract, up 1.88% off of the session highs. Mid caps up over 0.75%. They're off session highs as well. The Dow Jones up over 0.5 percentage point off of session highs. And the small caps rallied right into a supply zone. We're holding it at current. Not anymore. How many? We have 10 seconds left to go in this bar. Let's see if they're able to recapture this resistance level. It's a 5-minute chart. Doesn't mean all that much, really. No, they were not. So that's the equity market. We're up. We're off session highs. So I wouldn't get uber excited here. Tomorrow morning is going to be what we need to be watching out for. What's the quality of the open, and more importantly, what's the quality of the close? Do they gap us up and fade us into the close, or do they gap us up and close us up and we close near the highs of the day? That would imply that we're going to get higher highs. The former, if they gap us up and they sell us off into the end of the day, well, that means that the rally's probably run its course. Here's the US dollar, which is down relative to the close on Friday, down at current. Whereas the euro, man, the euro and yen, in particular the euro, relative to the U.S. dollar. I'm going over to London and Ireland at the end of April, beginning of May, and this is not good for me. I ought to be buying euros right now. It looks as though we're moving up a lot higher on the dollar. Excuse me, the euro versus the dollar. Let's check in with the yen. Yen is down at current, holding on to a support level. I'm still bullish on yen. Let's go back, 5-minute view. Let's bring up gold. Gold trading down 0.42%, a gap lower. So what this implies is that what we're seeing is a bit of risk on in the equity markets. Therefore, money is coming out of gold because gold has been acting along with the staples as a proxy for safe haven, whereas because the bond market is just simply not working right now. It's not working. And that's really bad. I mean, when we'll talk about the yield curve in a little while, but going back over the course of history, bonds are typically the go-to for money for being a safe haven. Not this time around. And I'll tell you, looking at the chart of yields, not years, looking at the chart of yields on a yearly basis, that's how we look here, yearly basis, looks like we're going up higher. So buckle up. So gold down at current. Let's check in with silver. Silver is up 0.36%. Platinum up 0.75%. Palladium is what? What's palladium? Is that right? PI? No. PL? No. What's platinum? Well, palladium. There we go. PA. Palladium looking really good here. It's up 0.75%. Weekly time frame on palladium. It's been bouncing off of a breakout point for the past couple of weeks. Bullish on palladium. It has yet to run. It looks as though it's getting ready for a move here. Let's take a look at a 4-hour view. Here is the higher low. And we have broken out on palladium 4-hour time frame. We also have a Bollinger Band squeeze setting up. Keltner channel's real tight. Bollinger Band's real tight. Palladium looking good. Let's do energy now. We have oil moving up here about 0.25 percentage point off of session highs. Natural gas, which usually gives us a lot of delight with its volatility on Sunday nights, is down 1.11%. Fairly benign for a move on a Sunday night for natural gas. Bitcoin. Bitcoin had a great day yesterday, but today we saw a reversal bar. We're trading down here over a 0.5 percentage point on Bitcoin. What else do we want to take a look at? Let's look at food. What's food doing? Let's take a look at protein first. Live cattle. Let's go to a weekly chart here. Live cattle. In no man's land right now. Corn. Great week last week on corn. Big move up higher. Wheat looking really, really good here. It's down at current, but my guess is we're going to bounce off of that 21 period EMA in orange, and that price point is at 554. Where are we now? We're coming down here, right here. We're going to do a retest, and then we look for a follow through on wheat. Okay. Soybeans. They're trading up. How did they close out the week last week? Outside reversal bar on soybeans looking really good here. Good stuff. Soybeans want to go up. Why do I feel like I'm missing something? Maybe not. I did oil, right? I did oil. All right, let's say hello to folks. While I'm saying hello, let's bring up the NASDAQ. Okay, so it looks as though we have stabilized. Now, this purple line here, this is a 4-hour breakout point, and we're holding it at current. Now, they'll probably probe this a couple of more times, but this is setting up for a nice breakout. You could see that late last week. Good stair step up higher, higher lows, higher highs, good stuff. It looks as though we're going to continue that into the new trading week. Now, obviously, we have a lot of volatility out there due to headline risk, so just be careful. And let's go to comments. And then we want to talk about the week ahead. I just want to bring up who's reporting earnings this week so we could chat about that. Oh, come on. Here we go. I thought I had this up here earlier. Okay, let's do it. Mr. Tim, welcome. Jeff, good evening, Bob. Getting ready for a bucking Bronco trading week. Another one. Best recession indicator is the stripper index. Las Vegas strip club revenue is down 12%. Tips have slowed. Foot traffic is thinned. Dancers are feeling the pinch. Dancers are feeling the pinch. Thank you, Larry. Tal-in, hey, brother. Corey, hey, Tor thoughts on copper. We're going to be talking about copper in a moment. Copper versus gold. It's a deflationary picture right now with copper. More to come on that. Mr. Pete, welcome. Hey, Sean. The lovely Jody, welcome. Beat the like, baby. Beat the like button like a baby. Awesome. Yes, please like, subscribe. We got 43 folks on. Last week was our biggest Sunday ever. We had a lot of people, So like, subscribe, you know the deal. And happy Palm Sunday to all of our good Catholic friends, of which I happen to be one. Happy Palm Sunday, a very sacred day. Okay, let's get to it. Let's talk about the week ahead. So to start off with, I already mentioned this, but it's worth remembering. The reason why we're gapping up at current is because of a catalyst. Apple got a get out of jail free card from the Trump administration. They had to fly in 5 cargo jets to bring out, I think the stat is each jet can carry 5 million. I find that hard to believe, but 5 million iPhones. They flew in 5 jets to take them out before the tariffs hit. And then they got a reprieve by the government regarding tariffs. But as this came out today, Lutnick says semiconductor tariffs coming in a month or two, exemption, Apple only temporary. They want these factories out of China. I don't even think they care as much if they come back to the United States. They want them here, but they'll be satisfied with India or any other country that's a neutral player. And they just don't want them in China anymore. Frankly, after what the Chinese did during COVID with the medical supplies, can you blame them? Now, folks, if you're not part of our community, head on over. It's free. Enter your symbols here if you want to enter them in stock chart requests. There's the link. Franklin, hey, brother. Welcome. Okay, so the week ahead, we have more Fed heads coming out. They did us no favors last week. In fact, I want to go over the Fed's balance sheet. I went over this with members on the week ahead commentary. It's already been sent out. So on Monday, we have a couple of Fed heads coming out. Tuesday, start watching these numbers here. Import prices. There's a problem. Import prices should begin to tick up higher. Why? Tariffs. And plus the dollar is now dropping relative to the euro, pound, yen. So that's going to be inflationary in and of itself because it's going to take more dollars to buy goods from those countries. On Tuesday, Empire State Manufacturing Index. On Wednesday, retail sales. Capacity utilization, that's of factories, business inventories. Home builder confidence, that one should be interesting because you're seeing inflation. We're going to go over the chart of the CRB commodity index in a moment. Inflation is rising. Now, Thursday, we get initial jobless claims, housing starts, building permits. Really a benign week in terms of economic data. Now, in terms of, I got to refresh this because I was rather surprised earlier, and I'm still surprised. We were up in the 30s, way up in the 30s yesterday when I did the week ahead commentary. For whatever reason, we have now dropped down to a probability of an ease to 20% in May. So I'm not sure what drove that, but something to keep an eye on. It may refresh overnight. Even June dropped down here a little bit. July, still very positive for a move in July. Now, the Federal Reserve's balance sheet last week ticked up. Now, I've been predicting that the Federal Reserve will be very, very hawkish verbally. They will not imply that they're going to cut rates anytime soon. But they have a problem. they have a bully that's in the bully pulpit, President Trump. And he has zero problem using that bully pulpit. And he's used it before with Jay Powell. He knows what he's in for. So I'm going to go over the chart of the 10-year yield shortly. We had some good bond auctions last week, but they weren't good enough. And you could see that the Fed's balance sheet last week, which has been trending down, ticked up. Now, I'm not going to claim victory here, saying that I called it, I'm right, because it's only one up week. It's not a trend. You know, when you take a look at the 5-year view here, the trend is clearly debt is being rolled off the Federal Reserve's balance sheet. What is that doing? Well, it puts pressure on yields to move up higher because the Federal Reserve, they were the buyer of last resort back here, and that pushed yields lower. Now they're selling, and that's driving yields up higher because they're not buying. Now, in terms of valuations of the market, folks, I started this off earlier with regard to where we're at, okay? I called for a rally on Sunday night last week with the futures down on the NASDAQ about 5%. We were down big, and I was still calling for a rally. We got that rally. Now that we have that rally, I want to moderate a little bit. While I still think that we could have a short covering rally, a move up higher, I have an eye on the exit door. I was buying last week, bought more Boeing, bought TQQQ, bought some, what do you call it? The leveraged SPY. And I bought something else. What the heck did I buy? I forgot what else I bought. I bought something else. LABU. 2 tranches of LABU. And we're doing well with them. Do I plan on holding them forever right now? No, they're leveraged products. I want to trade them. I want to be out. I want to raise capital. I want cash. I want cash right now. I don't even want bonds. We sold our bonds 2 weeks ago and dodged a major bullet. The Buffett indicator. We remain strongly overvalued. Think about that. Think about all that this market has been through. Take a look at the triple Qs. Let's get rid of all of these. Okay. Take a look at the downtrend channel. This is a daily chart. Let's get off the daily chart. Forget about the daily chart. Here is the downtrend channel. We're not talking about at the Contrarian Trader. We're not talking about any longer daily charts. Forget that. I want to know what the market is doing on a weekly and monthly basis now. I want to know what the trend is. And the trend is clear. It's defined. It is down. Now, can we rally from here? Sure. But before we have a new bull market, we need to rally, pull back, higher low, follow through, break out above 466.64 on the triple Qs, close there, and then get a continuation move up higher. Then maybe you have a new bull market. But right now, when you take a look at this chart, and you have your stochastics, here, let's go to the monthly view. Stochastics on a monthly view. This is a momentum indicator. Why are you doing this? When you have a momentum indicator that is not only putting in lower highs, but also putting in lower lows, that's a problem. And right now we're flirting right here in dotted line. We're flirting with the neutral level on a monthly time frame. And if you take a look at SPY, the same thing holds true. We're rolling over on momentum. So while it may feel as though we've been through a lot, where it may feel as though, you know what, it looks as though buyers stepped in last week, they're going to keep the market buoyed up. The sell-off is over. The correction's over. It's safe to go back in the water. I would hold off on that because, again, go back to the two primary questions. Is the market cheap? The answer is no. It's expensive. What's changed? Question number two. What's changed? Do companies have visibility? The answer is no, they don't. Nothing's changed. So beware. Be very, very careful. Earnings coming out this week. We had some good earnings coming out of the banks. On Monday morning, we're going to get Goldman Sachs. And that's pretty much it. Tuesday, we're going to get Bank of America, Citigroup. What else comes out this week? Some insurers, CSX, which we own. Taiwan Semiconductor, UNH comes out. United Health Group. Amex comes out. Netflix, that really kicks off the quote unquote Mag 7 or the high beta trade, the high volatility trade. So earnings are now beginning to kick in here. So buckle up. It's going to be all about earnings for the next couple of weeks. Now, in terms of a valuation on a forward-looking basis, this is the valuation of the market on a rear-view moving basis or a trailing basis. On a forward-looking basis, the forward PE ratio for the S&P 500 is 19. The PE ratio is below the 5-year average, but above the 10-year. So even though we've come in quite a bit on forward-looking expectations for earnings, we're still pretty extended. There's no real value there yet. Now, in terms of concerns about a continuation move lower in equities, I mean, you take a look at the yield curve right now, and the yield curve last week rose by nearly 50% versus the prior week. That's a huge move. And to put it into even greater perspective, here's the monthly chart. Here's our notorious now red zone. And I've warned about us being or entering this zone for quite a while now. And you've seen what's happened to the equity market. This is the S&P 500. Look at gold. So we continue to move up. We are in a very dangerous area historically for equities. So please be very, very careful. Now, I mentioned earlier about bear market rallies. This was, since I was thinking about it, I saw this post. I figured I would share it out. Be mindful of bear market rallies. Bear markets make fools of both bulls and bears. So true. In the great financial crisis, the S&P 500 recorded over 6 bear market rallies. After the 2000 dot-com bubble burst, we saw 5 to 6 bear market rallies as well. That was a long bear market. I think that was about 2.5 year bear market. Now, in terms of yields, what we're looking at is catalysts right now to send the market either higher or lower. Now, I don't want to draw the picture that the stock market or the economy can't grow because you have yields moving up higher. It's what's the reason for yields moving up higher? That's the problem. It's not that we're seeing organic growth where it's sparking inflation, and it's the growth of the economy that's forcing yields up higher. It's not. It's that right now we have a destabilized global trading system, and right now we're kind of being viewed, for right or for wrong, as the pariah in the global system, and people are backing away from the dollar. They're backing away from our debt. Now, the strange part is that they're trying to reduce the size of government, reduce the spending, make the government more efficient. You would think they'd want to buy that debt in that environment, but they don't. They don't, because they want the old way of doing things. And the old way of doing things is the United States offshores its manufacturing. It prints money to pay off new debt, and that's what we do. The problem is that we're $36 trillion in debt. And the world is fine with that until we go to fix it. And that's what they don't like. They're afraid of it. They don't want anything new. They want the old order. They want the old regime. But unfortunately, it's unsustainable. And when you take a look at commodities last week, bullish reversal bar on the week. We had pulled back quite a bit. But last week, a very strong week for commodities, bouncing back. You could argue that it was gold strength, silver strength. Sure, why not? But oil's in here as well. So you saw good strength in the commodity basket last week. Unfortunately, that's inflationary. But right now, we're more, if I had to say, are we in an uptrend or a downtrend on the CRB commodity index? I would say that we are in a neutral zone. We put in a double top. We've broken down to new lower lows on a weekly time frame. The however is that, let's take out our crayon, see where the trend is. Have we broken trend? And the answer is no. We bounced off the lower band of the rising uptrend channel. So no, we're still in a macro bull market here, but we have a short-term blip on the screen. Now, I want to play something from, I got to stop sharing to make sure I did my audio right. Stop sharing. Audio, share audio. Cool. I'm going to play this. This is from Larry Fink, CEO of BlackRock. I disagree with him on one or two things, but mostly I do have some agreement with the guy. So let's hear him out.
The United States post-World War II was a global stabilizer. We are the global destabilizer.
Right. Now, Larry,
that's a very hard thing to say, because I pride ourselves of being, bringing the leadership, bringing the conversations. Yes, I do believe we're probably starting, if not, we're in a recession. Yes, I think the market is still underestimating how high inflation can get. If you factor in all the tariffs,
right,
you factor in all these other issues, it's going to be quite additive. I mean, I read in a report that if you just take the tariffs in the cost of home building, the average new home could be up as much as 26%. We already have a housing affordability problem.
None of this sounds any good to me, Larry. And it's all self-inflicted, by the way. None of it needed to happen.
This is not a pandemic. This is not a financial crisis. This is something that we...
Okay, so I'm going to pause here for a moment. So he starts off his commentary with the fact that the United States is the great destabilizer. The United States has had 4 presidents that have sold this country right down the river. You had Clinton, the Bushes, so actually 5. 4, no, 5, sorry. You had the Bushes, that's 2. Then you had Clinton, NAFTA. Then you had Obama. And then you had Biden. 5 presidents that did their darndest to sell this country down the road through horrible trade deals, through driving down the middle class, grinding them into the ground with higher costs. Companies offshored their manufacturing, yet the average employee, their rate of change, their quality of life is decreased. So he wants to blame fixing the problem on Trump. Where's the blame by any of these three? Pointing the finger at the prior presidents for causing this mess that has to get fixed. Now, he's right. He's right about the cost of housing is going to go up. The however is the if you get a tax bill that allows the American consumer to keep more of their money, and a couple of ideas are being floated out there right now. One is a dividend payment from Doge, 20% of the savings from Doge, $5,000 per household or per taxpayer. I don't know what the number is going to be. Nobody does yet. If there is, I'm not really in favor of that. That's just a one-time gimmick. I want long-term tax cuts. That way, if inflation is moving up, it's being offset by people being able to keep more of the money they earn. So the other thing that they're not thinking about is that they're thinking very, very linear. They're thinking about that all of these tariffs are going to stay guaranteed 100% intact in perpetuity. They can't, because we don't have the domestic manufacturing yet to offset the cost of the imports to the taxpayer. Once those factories are here and they're built, then you're really going to see a lot of inflation, because the cost to build out the manufacturing base in the United States, you're talking $1 trillion of raw materials that need to be mined, contractors need to be hired. And you think that yields are going up higher now? Wait till that happens. But that's okay, because if the consumer is earning more, then they're able to pay more. But they need to get the tax code under control right now, and it's not. That's the missing link. And Trump really ought to be talking a lot more about that. I don't want to hear about this one-time $5,000 giveaway. They need to cut taxes to offset these increasing prices on the American consumer. Doge is doing a good job, fine. Pass that savings along to the American consumer. Permanently, not one time. And you can see here that the rate of change on the 10-year yield last week has only been seen a few times. The last time was back during 9/11 and the dot-com bubble. Prior to that, the Russia default, long-term capital as well. And then back in the 1980s when Volcker finally broke the back of inflation. And you saw that several times, even spikes up higher, but we were in a stagflationary environment, so it was understandable. So I don't think that the rate of change here is sustainable. We'll probably get pullbacks and a more orderly move up higher in the 10-year yield. But yields they're going up higher. It's as simple as that. I mean, just take a look. I had the chart of the 10-year yield here up earlier. Here it is. Here you have it. This is a yearly chart of the 10-year yield. We're down so far on the year. But I'll tell you, where this is stock, I'd be saying buy. Higher lows, looks like it wants to break out to higher highs. Wedge formation. It's going up. So I don't have any delusions that we're going to get lower interest rates anytime soon. You know, you take a look at the weekly chart. Think about this. The Federal Reserve was buying treasuries last week, yet the yield moved up over 12% versus the prior week. They need to be buying a lot more to keep rates stable. Now, this chart here is fascinating. and you had to be a nerd like me, an economic nerd like me, to appreciate it. A lot of talk about inflation driving gold up higher, but the copper and gold ratio, which is a proxy for global growth, is signaling a deflationary depression. He could be right. He could be right. Clearly, gold is signaling that it is a safe haven play right now. Yields are not going down; they're going up. They should be probably be going up higher, and that's allowing for gold to move up higher as well, given our current inflation picture. But taking a look at copper in red, copper is at levels that we haven't seen since the financial crisis, since COVID, and here we are yet again. We're down lower now than where we were just after the financial crisis. So, longer term, I think that here's the contrarian in me. Like right now, short term, I look at this chart and I say, okay, I get it. Lots of concern about inflation, lots of concern about risk in the stock market. So gold is ripping up higher. I get it. We own it. We're happy. Good stuff. We bought more gold stocks last week. All good stuff. When I look at copper and I listen to these guys here who are supposed to be the smartest guys in the room, these guys here, former hedge fund manager, pontificator in chief, and CEO of the largest, one of the largest institutions in the world. Yet I'm looking at this chart and I look at the history of copper right now and I say, okay, copper is at historic lows relative to gold at current. But don't the policies of the Trump administration, don't they favor copper moving forward out a year and a half? God forbid you're looking at 2 years right now. These guys on TV, they don't want to talk about it. All they want to talk about is self-imposed damage that we're doing to ourselves. No, we're righting the ship. Whether you agree with it, disagree with it, I don't know that it's the right or wrong thing to do. I truly don't. But I know that the course that we were on was unsustainable and it had to be changed. So now the process has begun. So me, I look at this chart and I'm saying, man, I'm a buyer of copper here. I'm a buyer. I'm not selling it. I'm buying it because we're going to need to build out factories. I'm buying railroads. CSX, we own it. Bought more Boeing last week at the depths of the sell-off. Buying. Because these are the companies that are going to benefit as the United States manufacturing base begins to expand. As for the economic picture, it's really becoming more and more dire. The number of multiple job holders has never been bigger. And that's a big statement. We've been through a number of crises over the past 20-odd years, and it's a bold statement. Multiple job holders hit a record nearly 9 million in the month of March. As a share of employment, it has reached 5.5%, the highest level since the great financial crisis. People are working multiple jobs to make ends meet. It's not right, unless they want to do it. We'll skip that. The U.S. consumer sentiment is lower than the great financial crisis. Consumer sentiment fell to 50.8, the second lowest in history. The sentiment is lower than during every U.S. recession over the past 50 years. It's a big statement. Think about that. That includes the dot-com bubble, financial crisis, and COVID. So are we in recession? I agree with Larry Fink. We're probably, in a recession. But I've been saying that for quite a while. I think that we've been in a recession, but the Treasury just has been spending with reckless abandon, keeping the GDP growing and hiring more government workers to make it look as though employment was good. And if you back out government spending and government hiring, well, what economy was growing? It was probably contracting. Sectors where we're seeing revenue growth: healthcare. Start looking at healthcare. We bought LABU Biotech ETF for trade. Utilities, I don't favor right now because they trade inversely of yields. They had a good year last year. I don't favor them right now. Infotech, I think you need to really start looking at materials and energy. Let them report bad earnings. If they're going to report bad earnings and those stocks don't go down and they ultimately go up, that's a tell. That's the market saying, okay, they just reported disappointing earnings, yet their price is going up. They're not being sold. Why? Because all the sellers are gone. And now you have your investors out there looking at the long term saying, where are we going to be in 2 years? Are we going to need more railroads or are we going to need less? Will they be making more money or will they be making less money? So think more out 2 years and start looking at energy and materials. That's what we're doing here at the Contrarian Trader. Let's do some stock chart requests. I don't think we have too many tonight, so that's a good thing. QQQ, AA. And I have a couple of other scans I want to go over. CYBN. Okay, let's do it. So, folks, the show is brought to you by TrendSpider. Please take advantage of our discount, 35% discount minimum to TrendSpider using the link below, because you're seeing some interesting events unfold out there. I was looking for opportunities in the equity markets, and I went through a few of these scans, and one of them was 10% owners buying. Where is that one? Buying right here. And a familiar name popped up, and Carl Icahn popped up. Carl has been buying UAN and CVI. Now, UAN, this is a monthly chart of UAN. We'll come back to this in a moment. Let's get rid of this. UAN, look at this Bollinger Band squeeze here on UAN. It's been no reaction here but to a down market. It's like it's impervious to a down market. It looks like we are going to break out higher. And Carl Icahn owns it and he's buying more. So UAN, interesting, moving into the new trading week. The other company, I didn't take a look at the chart yet. UAN, I had taken a look. CVI. And by the way, CRV, which one is this? UAN. UAN EPS changed last quarter, earnings per share change, up 84%. Their 3-year rate is negative, but they had a really good quarter last quarter. So good old Carl probably thinks that it's going up higher, chemicals and agriculture. Now, the other stock he's buying, CVR Energy, it stopped going down. Relative to the rest of the energy sector, it's faring very, very well. I mean, just take a look. Let's do an overlay of the performance of CVR relative to the XLE, which is the energy ETF. And you can see that over the longer term, XLE is outperforming, but you can see that now it's beginning to push lower. Let's go to a daily chart. It'll illustrate it probably a lot better. Yeah. So take a look at CVR relative to the XLE. It's actually now outperforming the XLE. So this chart's looking interesting as well as a potential buy. Now, the other scan I wanted to bring up was CFO buying. That's CEO. I want the CFO. Here we go. CFO buying own stock. Look at these names. Calavo Growers breaking out. Refi, Chicago Real Estate. Look at this. This is consolidating nicely. Potential move up higher. Clean energy. CFO buying stocks. Look at the tight consolidation here. CFOs don't buy their. I prefer when CFOs buy the stock than the CEO. When a CEO buys a stock, they feel they're the guy in front of the camera, not the CFO. The CEO has to own it for appearances. The CFO, he may already own stock, but if he's going into his pocket and he's buying more stock, he knows the numbers. So I find it very interesting when the CFO is buying the stock. So this stock has a nice Bollinger Band squeeze setting up. Firming up very, very nicely. So play around with this if you're a member of TrendSpider, and a lot of great ideas. A lot of great ideas. Look at the stochastics hooking up now. $1.50 a share. All right. Jody. Just looking at crude oil this week still. Yeah, I'm not buying crude just yet. No. I think that it's in the same bucket as copper right now. Once we begin to see growth of any type in manufacturing or a strong GDP number, then I think you need to be an owner of oil. Buy IEP, okay? IEP, let's bring it up. Weekly view, nice consolidation, but it's a little bit weak. This is Carl Icahn's company. I think he's got some issues with corporate governance. I don't know if it's with the government, the federal government, the state government. Something happened, or SEC. Something happened. I know there was something in the news not too long ago about Icahn Enterprises. So just be careful. Let's do it. QQQ. So we know that the trend is down. I already drew these. Let's get rid of that one. Let's go to the weekly, monthly chart. Let's start all over again. I'm going to get rid of all these, start fresh, remove all annotations. Yes. Much better. Here, back to the weekly chart. So it's respecting the upper band of the downtrend channel. So QQQ remains in a downtrend. I don't care what it did last week. It's what it does moving forward. Right now, I would not be an aggressive buyer of Qs because you're betting that it's going to break out. But remember what it's doing on a monthly time frame. Stokes are rolling over. They'll soon be trading down below 50, and we know that rallies tend to fade. So we can move up higher. I'm not saying that we can't. I think that we can easily move up higher, but I think that it's a bear market rally, and it's probably going to be one that we're going to be selling our TQQQ. That's the leverage product, which we bought on the Qs. We added more last week, but I'm probably going to be selling that, and probably when I see weakness, getting short yet again of the Qs, especially if earnings come in as expected, which is supposed to be weaker than expected. AA. Alcoa. I think this falls in the camp of U.S. Steel, which we bought last week. It's one of those companies that we need good GDP reports. We need news headlines that are showing that we're seeing manufacturing returning to the United States. We need roads being built. We need more manufacturing. Once that starts happening, you're going to see Alcoa move up higher, especially with the tariffs on imported aluminum and steel. So right now, does this chart look good? No, it looks horrible, to be honest with you. Would I buy it? Yeah, I would. I think that they killed this. It was in a downtrend. They broke it down below the lower band of the declining downtrend channel. I think this could be bought. Would I be an aggressive buyer? No. This is a stock I would tuck away at 25 bucks a share. And once the news cycle begins and it starts rallying, here's a stock that was trading as high as 67 bucks, 68 bucks the last cycle. So you're getting the stock more than half off of where it was trading back then. If you believe that there's going to be a resurgence in manufacturing here in the United States and the demand for U.S. aluminum, then you want to own Alcoa. CVI. CVR Energy looking good here. I like it. I think it's a buy. We retested the lower band of support. We're in a tight wedge formation. I think it's looking very good. Daily view. It's okay on a daily time frame. I wouldn't buy it as a trade. I would buy it more as a long-term hold. Again, if you believe that there's going to be a rising demand for energy prices, then you want to buy energy, but buy best of breed. CYBN. Outside reversal bar on the week last week. Good looking chart. I think we're going to pull back this week, do a retest of around 625 per share, and then it goes up. Bullish. I like it. Daily view. Yeah, I think we're going to get a pullback and a retracement here. I'd be a buyer on that retracement. What's seasonality look like for this company? Do we have more data? No, we don't have enough data to talk about seasonality. Let's go to Alcoa, check out seasonality there. We know there's plenty of data there. Back 50 years, it's a little bit too much data. That gets dilutive. Let's go back. Since 2009, since the financial crisis, we're in a weak period of time between now and July. In June, if this sees the doldrums, you want to be a buyer on a rally into July, which is generally up 63%, where May and June, it's usually up by 31% and 38% respectively. To the question by Franklin about Qs, seasonality, going back to 2009, the month of April, we're up 65%, May 63% on a weekly time frame. The week we're heading into is a coin flip. The week thereafter, pretty strong. And then we hit a rough patch. So if they rally this market this week, they close it strong, then we should assume that we're going to get another weekly higher high thereafter. But we're going to want to pay a little bit of respect to seasonality, because that may be the trigger that sends the markets down a bit lower and could take us out down to new lower lows. Unless we grow into current multiples, the stock market is very, very expensive right now. So equities need to come down lower. So earnings are going to be very critical. Don't ignore earnings just because everything's all about headline news. I wouldn't do it. If earnings come out poor, I shouldn't say poor. If earnings growth decline, then you're going to have a very hard time of growing into our current multiple. It's going to take a long time. So I think that we do need lower prices on the equity markets, and significantly lower prices. And until then, we're gonna enjoy the rally up higher, if in fact we're given one, and then we're gonna look to add to shorts. I don't have any shorts right now. We're gonna look to build a short position and look for the next leg down. And that's it, folks. Everybody have an awesome night and a profitable trading week. Thanks for being here. Like, subscribe. You know the deal. And don't forget, TrendSpider, get that minimum 35% discount code. Link below on YouTube, link above on Twitter. Everybody have a great night. Be well. Happy Palm Sunday. Be well.